My name is Angela Emsley and I'm President of AIST and Chair of HESTA, and a very warm welcome to what I think is going to be a very interesting and engaging session, the fees debate, the elephant in the room. And I think in fact we've already had quite a bit of a lead up to this topic, starting with Tom in the intro to the conference and a range of other sessions that have touched on this. So I think today hopefully we'll be able to build on that discussion. And I should say that we're going to specifically focus on investment management fees today, not only because this is an investments conference, but also because it's by far the largest component of a fund's expenses. And as Tom said in his introduction, AIST wants to raise the level of debate on this issue to make sure that as our funds continue to grow, the benefits of that growth accrue to fund members rather than to agents and intermediaries. And of course, returns to members should be the ultimate test, but our commitment to our members and how we get to that net benefit needs to go further. And I think this is really because the environment is changing. We've heard a lot about the environment changing in terms of a low fee environment, and I think also the regulatory environment is changing and funds can't ignore that. Banks have introduced low-cost MySuper products, switching the debate from returns to fees. Murray, Frydenberg, Grattan have all told us that fees are too high and that we need greater competition in the default fund system to drive down fees. And as recently as last week, the Minister said, "I firmly believe in the benefits of competition and its power to put downward pressure on fees and increase the quality of superannuation products." Also last week at the National Reform Summit, Grattan Institute its Chief Executive John Daly claimed fees associated with super accounts cost Australians $21 billion a year, the equivalent of half the national age pension bill, all due to insufficient competition in the sector, in his view. He claims that up to $5 billion in fees can be saved via a tender process to select a series of no-frills products. No-frills, that's really hard to say, no-frills super products. And as Tom also said in his introduction, the National Seniors Chief Executive Michael O'Neill also weighed in last week, saying that if fees did not come down, a future government might have to ask the regulator to step in. And I don't know if anybody's seen this, but Fiona Trafford-Walker pointed this out to me. Even the government's own MoneySmart website says its first point in how to choose or compare a super fund is the cheaper, the better. And on top of this all, as I said, we have a very low return environment combined with fairly high member expectations. So this is clearly an issue that funds can't ignore if we are to do the best by our members. And I believe that not-for-profit funds have been put on notice that we need to further demonstrate our privileged position in the default system. The FSI has put a stake in the ground, suggesting a required improvement over time, I think by 2020, saying that outperformance has not been enough. We need to have a greater focus on costs and value for money, not just returns. We need to counter arguments that not-for-profit funds can become inefficient due to lack of profit motive, lack of competition, and lack of focus on expenses. We need to ensure that any increase in competition does not come at the expense of long-term returns and or too much of the pie accruing to others other than members. Funds such as my own, such as HESTA, have already done a lot of work on this with some limited progress. At AIST, we believe it's an industry-wide issue, and as Tom said at the outset, AIST intends to work more closely with Frontier and ISA to promote a collective impact approach of how we can work together to improve the system for members. After all, I think it's in all of our interests to make sure the system is working as efficiently as possible. We've got 3 polling questions for you today, which we'll quickly put up on the screen, but I'll give you the benefit of working through those as we start the session rolling, and we'll come back to them later on after we've heard from our speakers. So no rush, but please answer them during the next 10 minutes or so, that would be terrific. So the questions are going to be, does your fund have a target to reduce investment management fees? The second one will be, is your fund rethinking any aspect of its investment strategy because of investment management fees? And the third, has your fund walked away from an investment manager on fee grounds? So I'll be very interested to hear the outcomes of those. So to introduce our panel, we have a very esteemed panel of 3 consultants, a chair of a fund who is also a former consultant. So we've got lots of analytical brains on the stage, apart from myself, I think. We have, to my right, Fiona Trafford-Walker, who's Director of Consulting at Frontier Advisors, Ken Marshman, who's Chair of REST Industry Super, Ian Friar, who's Head of Research at Chant West, and Michael Rice, who's Chief Executive Officer of Rice Warner. And their bios are all in the conference pack, so I'll leave you to read that at your leisure. Now, the very aptly named fee is going to start the ball rolling with a presentation of the work that's been undertaken by Frontier on this issue. Then I'm going to ask each of the panel for a short comment, and then there will be an opportunity to see the results of the polling and have a broad and open discussion. And we look forward to lots of questions from you and a robust discussion. So if you can join me in welcoming Fiona Trafford-Walker to the stage to start the ball rolling. Thank you.
Okay, thank you, Angela. Thank you, everyone. Just wanted to make a couple of initial observations before I make the formal presentation. And the first thing is about the title of this presentation. Yes, it's about fees, but more importantly, at its heart, it's about realigning the interests of funds with fund managers. And I think, as I've been in this industry for more than 20 years, and I've seen a huge amount of change in that time. And the last couple of days, I've really sort of thought that we are seeing a very strong move and, I guess, restoration of power, if you like, from fund managers and consultants back to the funds, which is where it belongs. So the theme for me today is really about the messages I've heard, and I'm sure you've heard as well, is the funds are taking charge of this issue. They're doing things already in their portfolios that are basically saying that the model we've had for the last 15 or 20 years isn't the one that they want for the future. So what we're trying to do with this is to think about, well, how can we make a better model, make a better system that works for everyone better? I remember going, I think it was this conference maybe 10 or 15 years ago, and the message used to be from the managers that we have this skill, we can get you alpha, and if you pay us some fees, we'll let you share the alpha. Today, it's about the client saying, no, we're in charge of that decision, we're in charge of our structuring, we will bring on our own internal people. And someone yesterday said that the competition for funds managers will in future be internal teams. And that applies to consultants as well. So this is not simply about fund managers. I think everybody in the industry needs to evolve. One thing I don't say much in this presentation is net returns. The reason for that is it's obvious. We're all here to get good net returns for the funds, but the difference between gross and net is fees plus other things. And so we can control the fees. We can't always control the gross returns, but clearly that member promise of net returns is paramount, but today we're focusing on fees. And as Angela said, there's an imperative coming from the regulator, the government, and even I think indeed from the public about what they expect of this industry that's very important to all of us. So why does it matter? Some of this is obvious, but I think the first one for me is that the money belongs to the members or the sponsors who ultimately then flows on to the members, and they're the ones that take the risks. So they ought to get their fair share of the returns from that, so they ought to get their fair share of excess returns generated by managers using the capital. The other thing, which is a big one, which has been also a theme in the conference the last few days, has been the return environment's expected to be lower. So if you're charging, say, between 80 and 100 basis points and you're returning 12, that's still not great, but it's better than if you're only earning 7. So that lower return environment means we have to do everything we can to capture as much of that for members, and a big part of that is trying to bring fees down. We all set objectives. They're all mostly real return objectives, and that member promise is very, very important, and I think that for me is probably one of the biggest rationales for me doing this kind of work. The other one that's increasingly important to me, I think, when you've been in industry for this long, and I know many of you have been in the same amount of time and some longer, is that there is an issue of lack of trust or reduced trust in the finance industry. And I think that it is imperative that this group, and others that work in our part of the industry can step up and change that. And that's really about making sure that when members invest with a fund, that they know that there's trust, confidence, integrity, because that affects all of us, and it affects society more broadly. So I think that the regulatory pressure is coming, but I think the pressure ought to be something that we have internally anyway, just to do as good a job as we can. So I'll just quickly address this question of whether Australian fees are too high. Everyone always goes on about this OECD survey and says, oh, you're very expensive and, that's bad. But I found some work that Schroders did on this, and when you actually compare like-for-like markets, Australia is not as expensive relative to others as it first appears. So if you take out markets with very large defined benefit funds, for example, the Australian median is 0.78. The median of the other funds, once you adjust the survey, is about 0.75. But I think even 0.75 is probably too high, and I think it does depend on the fund. But if I think returns are lower, you really need that number to be probably around 50 to 60 basis points, depending on the size of the fund and what the value proposition is. I think some smaller funds that want to offer something very special to their members, then you could charge more because you're giving a different service. But really, even at nearly 80 basis points, that's probably still too expensive. But it's a global phenomenon. It's not just an Australian phenomenon. And when we look at why fees are too high, there's a few reasons, obviously. I mean, costs generally are high, but when we look at where the costs come from, Andrew Baker from Trier did a study last year which showed that for an average fund with an MER of around 90 basis points, about 65 of those were investment management costs. So when you look at where you're likely to be able to save money, that's where the funds are going to look first. And that's indeed what's happening. If you listen to what the funds have said to you in the last couple of days, that's where they're looking first. There are other ways to save money, obviously things like custody and things like FX trading and interest rates on cash accounts with custodians, all those things. You can certainly save quite a lot of money by being careful there. But the big cost, and maybe the elephant in the room, really is investment management costs and what we can do about those. The other thing that seems to happen is that as funds under management goes up, revenues go up, fees go up, expenses go up, and there isn't necessarily a culture of cost control in some funds management firms, except when you hit stress in markets. And I think when you hit stress in markets, and this was actually the beginning of the discussion that Ken and I had in 2009 and 10 about trying to bring in some fee principles, because a fund manager rang me in, I think it was 2009, and said, look, I've got some bad news for you. We're going to lay off 20% of our staff. And I said, wow, that's really awful. And then he said, but don't worry, they didn't have anything to do with the investment management process. So I said, well, what were we paying for them for then? And that made me think, hang on a minute, this is all wrong. Funds management businesses, the revenue comes from something they can't control, which is the market. And that's where we generated the fee principles from. So I think that if you think about the funds, the firms, investment managers as businesses, companies as businesses, funds as businesses, it's really just about trying to recognise that how do you capture benefits from scale? How do you get your costs under control? And I think that we want to be in charge of that proactively, not have it forced upon us as an industry, which I think is a risk. That's just the article. It's, if you're interested, it's part of a bigger article on a website called Trier Log from December last year. So then we looked at, well, why are funds management fees high? And it's partly, there's definitely a sales and marketing culture around the funds management industry where you're selling something to firms, to funds, that's perceived to be in short supply. And that's the capability to generate excess returns or alpha. And it happens in other areas too. So it's this concept of what the economists called economic rent. And you can earn economic rent if you have a skill that's either in actual or perceived short supply. So movie stars get paid a lot of money because they have something that people perceive is in short supply. You see it in elite sports people, particularly in the soccer league over in the UK. And I think the funds management, the same kind of parallel exists where there's a perception that you have skill to add excess returns. It exists in consulting firms as well. You're selling something that you hope you'll be able to deliver in future. But excess returns are not guaranteed. And the other issue is that if you don't perform very well, then the fees have been paid and you can't do anything about that. The worst that can happen is that you get sacked. There's no way of getting money back from fees that have been paid. And the ad valorem fees, the basis point fees or fees on funds under management, are also a big issue for the funds, because that also makes it very hard to capture benefits from scale from a super fund perspective. So when we talk to managers about fees and we say, well, can you rethink your fee structure? Can you give us more benefit from scale? There's lots of reasons given and impediments towards reducing fees. And I've listed some of them here, but the Rich and Brandweiner talks a lot about agents and agency risk, and I think there's almost another level occurring now when you have agents appointing agents. And so there's a lot of people in the industry that all need to be paid, and that increasing specialisation in the industry is also causing that structure as well. There are lots of entrenched practices like 2 and 20 in hedge funds and private equity. If you were building a financial sector today, it would look nothing like the one that we have. It would look very different, but we have a lot of entrenched practices that are very hard to change. The other thing that happens is that the best managers set the prices and the others follow. And there clearly are some very good firms and they're worth paying for, because if you want to get net returns, you're happy to pay when you think you have conviction in it. But there are others that are probably not as good, and so the sense of conviction in your portfolio is really important. The other line we get is that, well, we can charge our American clients that, so we have to charge you the same. And I think that it is really just a matter of time before pension funds everywhere start to step up and say, well, we're not going to pay that. You're seeing it in Canada, you're seeing it in the Netherlands, it's in the UK. You're even now seeing CalPERS talking about what it pays. So I think that line that, well, we have to charge you these fees because our other clients pay them globally and we can't have different fee structures, most favoured nations, blah, blah, blah. That just won't fly, I think, in time. So if you work for the global firm, that's something I think you need to think about. One thing that really always surprises me, it's a bit weird, is that there are a lot of suppliers, but there's very little competition. There are 140 Aussie equity managers, but still the fees are relatively high. I've never really understood that. I do think possibly it's buyer inertia, as in maybe the funds don't negotiate hard enough in general. I think many of them are negotiating much harder now, which some of you would have been party to. The other thing that they also say is we have to attract and retain the best talent, and it just becomes this spiral upwards because everyone gets more expensive as they go from job to job. And so these things are all impediments to reducing fees, and I think that what we've seen as a result is that a lot of these things are going into the funds. The internal teams are being built to combat some of these entrenched practices and impediments. So if you're a super fund, what can you do? Because I want it to be action-oriented, because I'm very conscious that it's really easy to stand here as a consultant and say you should do these things, but then not have any things you can actually do, or that we weren't doing anything ourselves. So the first thing I think is you can adopt some principles that guide your decision making. And this won't be right for everybody. In fact, there are many funds that might look and say, look, we're happy with the fees we're paying. We think they're good value. That's great. It is really about the value you get and your conviction in what you're getting. But if you have some principles that guide your decision making, then you can make sure that the relationships between you and the managers are commercial. We want the businesses to be sustainable, but we also need to see some realignment, I think, especially as the funds grow. Introduce some fund-based and fund-wide KPIs, and I think we've seen this much more. I mean, we heard from Gesby this morning talking about a fee budget. We've heard other clients saying, well, we would like to reduce MER by this over the next 5 years, but it has to permeate the whole fund. And in fact, it has to come from the board. So as a board member, if you think it's important, then you can pass it on to the CEO, the CIO, the investment team. But as I said, this isn't going to be for every fund, and what you do at every fund will be different. And I think that's where the ability for the fund to have its own commercial view of what's important for the fund and the relationships is important. Ask for scale discounts. This is a big thing, and I think that the industry could do better, which is to say, how would you allow for the fact that we will grow and the marginal cost of investing that extra dollar is much, much lower? So ask for aggressive scale discounts, and I think that's just really a fairer fee structure over time. And then if you don't get them, you need to walk away, because that's kind of negotiating 101, and I think being prepared to walk away, because when there are 140 Aussie equity managers, there's always another one. Now, where you'll have trouble with that is if someone is really, really good, and I think that will be reflected in the commercial arrangement that you as a super fund agrees with them. Disintermediation, insourcing, this has already happened, and as I said, I think internal teams will increasingly become more competitive with funds managers, just in the same way they've become competitive with consultants. So a lot of the work we did 5-10 years ago is done inside the fund now. It's quite a logical, natural evolution, I think, but it's confronting. So, we and, Jana and other consulting firms have had to change that we deal with our clients as well. This is one thing that hardly ever happens, which also surprises me, because we have to retender every 3 to 5 years for all of our clients, but managers never have to rarely have to retender. The contract just goes on and on and on, and I think that it would be healthy to say it's a 3-year contract. If you do a good job, it'll continue, but at the 3-year mark, we want a chance to say, look, this isn't working for us, we need to change the mandate, change the fee. There could be good reasons to review the mandate generally, and use that as a chance to reset the business relationship between the super funds and the managers. It happens across the industry: custody, tax advice, legal advice, consultants. So there wouldn't be a big stretch for that to occur in the funds management area as well. Choose managers that you think are more aligned with you and what you want to achieve. And again, as I said, there will be managers that are very good at their job. There certainly are. And if they can give you a fee structure you think is fair, then you should go with them. But if you can't find one that is aligned with your interests, or the fee structure is not right, then I think it's a chance to walk away, to rethink, to go and find other firms. Break the link between fund growth and the fees that you pay. It's really important, I think, because that just keeps the costs going up and up and up and up. So thinking about CPI-based adjustments, they're more common out in the real world. It's unusual structures we have in the funds management community. But if you could do that, even just doing that would reduce fees quite noticeably over the next 5 years. I'm just going to skip a few slides because I'm a bit squished on time. Oops, that didn't work. So if we work on the basis of the OECD numbers, and it's 78 basis points for Aussie funds now, if funds grow, between the next 5 years, if funds grow from 3.1 billion to 5.5 billion, it's a 10% growth per annum. Sorry, this has really gone a bit skew. If we take out the link with the market and we just grew that at CPI, then that 78 drops to 53. That's a huge, huge fee reduction. And fund managers would still be making good money in that environment. A CPI adjustment is usually enough. That's the sort of adjustment that most consulting and other firms would have. So quite a lot can be achieved. I'll skip that as well. Just what a couple of industry perspectives. These are two people who I personally regard very highly. And they are really sending a strong message. And if you look at what both those funds are doing in their firms, they have recognised that this is a challenge, and they're doing something about it. And it is a chance to say, well, the old model doesn't work anymore. And I think that's really the message. And I think, as I said, before you get your voodoo dolls out and stick pins in me, this is really an issue for everybody in the industry, including consulting firms. And we all need to evolve, because I think the funds are telling us with their actions that what we've done for the last 15 to 20 years isn't what they want to buy in future. And there's no point offering something that no one wants to buy. I think innovation's really important. This isn't about a blunt tool to just bring fees down. This is about a way of just restructuring the way that the funds work with fund managers. And I think if I were working at a fund manager, I would look at what I thought the industry would look like in the next 5, 10, 15 years, and I would think, what would a successful funds management business look like in that structure? Fewer funds, very big funds, big internal teams. It's a very different environment to operate in. And then to finish off, just went a bit crazy in this one, but it all seems impossible until it's done, Nelson Mandela, so it doesn't come any better than that. Thank you.
Thank you very much, Fiona. I'll now hand over to Ken Marshman from REST to give us a bit of a chair's perspective.
Two comments I'd like to make. Firstly, REST position on fees. A REST industry super member, over the last 12 years, investing in fixed interest, has had a higher balance relative to passive of 7% over that 12-year period. In global equities, that REST member has had a higher balance through active management after fees of 25%. In Australian equities, the REST industry member has had a higher balance through active management of 37%. Active management is important. It is something that we believe in, and so what am I doing up here talking about fees? Because if we don't do something about fees, I am very scared that advertising, governments, marketing forces us down a route of passive, and that is not in my interest, in my members' interests. The second point I would like to make is I am going to predict that in 5 years' time, the average fee, investment fee paid is reduced by 50%. 50%, where does that come from? Well, there will be the benefits from the advantages that fees just taken us through. Internal management. Peter Curtis told us yesterday, internal Australian equities managed 9 basis points, down from 50, I think he said, when it started. But most important, this is an industry that is ripe for disruption. This is an industry ripe for disruption. The 3 factors: it's institutionalised, it has a profit margin somewhere between 40 and 60%, and it has very low technology access today. How might that happen? Now, I'm not a futurist, but I'll give 2 suggestions. We heard yesterday from Professor Marshman that when you mix technology together with ETFs, low-cost ETFs and index funds, it's a marriage made in heaven. The fee might be $1.99, the cost of an app. That's what is going to cut into fees, possibly. And the second, taking along the idea of the Grattan Institute, it might be that, and this came from the session yesterday, the day before, on multi-asset investing, it may well be that funds themselves decide to throw out half of their fund to tender on multi-asset funds. And I think that if a manager had the whole fund, or a large slab of it, all those asset classes managing to an objective, we might find very, very, very tight competition. So that's my punt. Thank you.
Thank you very much, Ken. Now we'll move to Ian Friar, who will give us a view from the perspective of having done a lot of comparisons of super funds.
Thanks, Angela. Thanks for Fiona for putting our attention back on fees. Well, not back on fees, it's been there for a while, but we can't forget fees, can we? We want to make sure we don't pay managers more than we need to. Net returns, though, are the most important thing, and we don't want to get to the stage where we choose to reduce fees by 10 basis points, knowing in the back of our head we're going to reduce returns by 30 basis points. That would be bad for everyone. The fiduciary duty of trustees is not to have the lowest fees. The fiduciary duty from an investment point of view is strong returns, best returns for members. Indeed, some of our work has actually shown that there can be a positive correlation between investment fees in the fund, the MER, and long-term returns. The funds, in particular the industry funds, that have spent more money on high-quality alternatives, on unlisted assets, on high-quality listed managers, concentrated managers, etc., they typically have performed better over the long run. The larger industry funds typically are the ones that have done that, and they're the ones that have outperformed. It's not always the case. High fees doesn't necessarily get you better returns, but we've seen a correlation there. Another question to ask is, where are these fees paid? While most of the assets are in the listed space, most of the fees tend to be in the unlisted space. So say, for example, listed markets, which will have most of the assets of a typical fund, Of the standard 60 basis points, which is what we see across the industry at small, medium and large, that's the average investment fee that we see, probably, especially at the larger end of town, 20 basis points of that might be listed markets, the fee for listed markets. The rest is going to be some internal stuff, plus also the unlisted. So if you think about listed markets, the Australian share managers, international share managers, etc., you're paying 20 basis points there. If we go really, really hard and reduce those fees by 25% in terms of a percentage, which a lot of people around here would say is just impossible, what would we save overall on the MER? That 20 basis points will go down from 20 down to 15. We'll save 5 basis points. Now, I'm not saying we shouldn't try this, but let's just put it in perspective that when we look at performance, we have performance tables where we show the performance to the nearest 10 basis points. So that 5 basis point saving may not even be seen in the returns that are published. The unlisted space is a different matter, of course. Maybe 20 to 30% of assets, but most of the fee. So it looks like we'll get more bang for our buck if we try to hit that, but it's hard there, isn't it? There is scarce talent. There is little competition often in that space. And also some of the areas like private equity, they're not as scalable. Those private equity managers are often quite hands-on, and managing double the money can sometimes take a fair bit more work. How do we reduce some of those fees? Well, some of those asset classes like infrastructure, unlisted property as well, co-investment, or the term I've heard recently, club investment, where smaller funds get together and invest. That seems to be a way forward, moving away from the fund of funds, which is the 2 and 20, partnering with the fund manager, so the fee is lower, but also it's good for the fund manager because the fund manager can say, look, we're actually getting certainty of funding here. And my last point, because I've gone over time, is this. Let's say, for example, that you're an aspiring CIO and you think, I want to get a job at one of those big Canadian or US pension funds. And you go in for the interview and you're asked by the interview panel, what's your strategy for improving the investments here? And you say, well, fees are too high. Every dollar of fees is $1 out of your members' pockets. We need to cut out expensive asset classes like private equity. That'll cut our fees down. That is a good thing. What do you think the response would be from that board? The response would most likely be, that's interesting. That's an interesting view. Thanks for your time. We'll get back to you. We've heard enough. The way they think, the way those groups think is about net return. And the idea of throwing out an asset class or even cutting it back just because of a headline fee would be seen as ridiculous. So anyway, that's just net returns have got to be the focus. Yes, let's look at fees, but let's have some perspective on what we're trying to achieve. Net returns, not low fees.
Thank you. Thank you very much, Ian. And now to Michael, who's had the perspective of both being on an investment committee and analysing fund returns and outcomes. So over to you.
Thank you, Angela. Well, fees. The first thing is that measurement of fees is itself an issue. For example, the ASIC APRA fee disclosure on MySuper does not look at interest margins. So we've now got some choice products that are 50% in cash, and they market themselves as being the cheapest. So we've got to be careful about being prescriptive and describing things in a way which is not in the long-term interests of members. A point I'd like to make is that scale is very important, both on operating costs but also on investment management fees. We've got 104 MySuper funds, another 13 that are funds set up for very large employers like Woolworths. And a lot of people say this is too many. If we had a cut-off that every fund had to be $10 billion, we'd reduce to less than 30 funds, and the industry average fee would drop from about 105 basis points to 90. So even consolidation could cut our fees in the industry by 15%. And that's partly why commentators have suggested that we look at auctions and other ways of reducing the fragmentation of the industry. It tells us that smaller funds are more expensive, and they have to question whether that can be justified to their membership. But it doesn't necessarily mean that they need to give up. They could think about leveraging the scale of larger funds by some sort of joint venture. they could focus on their MySuper strategy and outsource all their choice options, or they could even do a deal on the MySuper itself. And by the way, it baffles me that the SMSF segment is actually the cheapest segment, but that's again a scale issue. It's because their balances are very high on average, and so they get the benefit of that scale. Whether it gives them good returns or not, it just depends on whether equities are doing well, because that's where they're mainly invested. Now, as the other speakers have said, you can't look at fees and costs without considering the implication of returns. There's been a lot of comment on passive investments. I personally believe there is a place for passive. In some cases, QSuper, for example, has a very big core passive portfolio. And if you had no other information, it would be the core. You would say that's your starting point, and then you would assess the extra costs, taxes, and risk of active management before moving away from it. And obviously funds that are successful, such as REST, have managed to work that out properly. But you could, even if you're a small fund and you wanted passive, you could put the minimum amount, if you have an asset allocation range, into passive and play with the active, the greater proportion of your strategic asset allocation, even shorting the passive if you wanted. Another point is life cycle funds. These have tended to be set up where the fees are lower when people have the most money in the fund, and life cycle, target date, whatever they're called, I personally think that they reduce performance and reduce members' retirement benefits. They worry too much about sequencing risk at the point of retirement instead of building retirement over 20 or 30 years, as most of us will live if we're lucky. So the issue there is, I think you should stay in growth assets until you're in your 80s, and no funds seem to share that view. Another trend is in-house investment management. Again, funds need to consider, will the return and the extra risk justify the saving in costs? And I think these funds have been out too early for us to tell that, but there are obviously big risks of doing things yourself. So in essence, any asset allocation decision must take into account risks, costs, taxes, and ultimately the return that you're going to get. And I think in the industry there are far too many decisions that are made looking at components of these things.
Thank you. Thank you very much, Michael. Fiona, do you want to just give us a very quick response and then we'll go to the floor for questions?
Yes, sure. I'm sorry. So I've got short legs, so I can't touch the ground on this stool.
Me too.
So I just, look, I support everything that my three fellow panellists have said. I mean, we're very much on the same page on a lot of things. I just would make three observations. One is the overseas comparisons are really hard because the markets over there are very different. So when I look at the Canadian market, for example, it's big defined benefit funds. They don't really compete with each other. They don't have a regulatory environment like we have. So they're in a rather privileged position where they haven't got to worry about some of the things we have to worry about here. That said, there's a lot to be learned from what, for example, the Canadians are doing. I think they're amongst some of the best investors in the market in the institutional space. For me, this is about capturing scale back to members. The funds are big enough now that they can do a lot of things on their own. It's about recognising as they grow and continue to grow that most of that, the value that they get from being larger, and I don't mean larger as in 50 billion or 100 billion, I mean even just a few billion is bigger, and how you capture scale. But yes, clearly net returns are the most important thing. I think for me it's really just how do you pull apart the net return and look at the pieces of it and what can you control and what should we do better? And so that's why the focus today is on the fees part, but net returns are clearly what we're all here to deliver.
Thank you. Maybe we could now have the answers to the polling questions. And if anybody in the room's got a question that you want to ask, now's the time to wave at me, because we're running fairly short on time for this session, unfortunately, today. I can't see anybody waving, so let's have a look at the answers to this question. So, yes, that's quite a definitive number there. 67% have a target to reduce investment management fees. If we could perhaps go to the next one. Yes, is your fund rethinking aspects of investment strategy because of investment management fees? An overwhelming 74%. And the next one. Has your fund walked away from an investment manager on fees grounds? 66%. So I think that's a pretty overwhelming message. Does anybody on the panel want to comment on any of those? I mean, I think that is interesting about the culture in funds and how the message is being sent from the board down about KPIs and our willingness to walk away from managers. Any comments? Ken, you look like you're ready for a comment.
Don't get me wrong, fees are very important, and but I think it's very important to know when to fold, when to walk away, and when not to. I think
Yes.
it's you don't want to be bloody minded about this.
No.
It can cost you. Yeah, that would be my point.
Ian?
I think I'd say that if you're getting median returns from a manager and you think you're paying too much, then go somewhere else. But if it's a high quality manager and you're getting good returns and also good service and other aspects, then stay with them. I'm in a fund, I won't say which one, but it's a fund which has quite high investment fees. I like that they have quite high investment fees, and I like what has happened over the past 10, 15 years from that.
I think one of the problems is when you ask a question like that in isolation, it's quite difficult to answer because you might want to walk away from high fees, but frankly, if you're getting a really good performance, you might try and negotiate, but what are you going to invest in instead? That's really the issue. If you walk away from an unlisted asset that's going to give you a good net return just because it's expensive, you should only do that if you think you can get a better net return somewhere else.
And clearly funds have decided that. I mean, many funds have said they have walked away. They've obviously gone through that process and decided that it's in best interests of members to look somewhere else.
Yeah.
I thought it was interesting that Fiona brought up the competition aspect, because that is a big difference, isn't it, between, say, the Canadians, US, Big DB and here. There is the competitive aspect, and that makes it hard for trustees. And indeed, for trustees it might be, well, how can we get new members if we are more expensive than others? I suppose I would say your main responsibility is for your current members and getting best outcomes for them. And I would say if you get good outcomes for them, then others will come.
Okay, now we've got, I'm conscious of time, but I know there's a couple of interesting questions here on the screen, particularly this first one, it's the second one now, but what's a reasonable profit for fund managers? I think, Ken, you mentioned that the profit margin as fund managers are in the realm of 40 to 50%. It says here on the screen, IBIS World data shows profit in fund management at 39%, which looks pretty handsome to other comparable industries. Would you like to comment further?
I won't say what's fair and not fair, but I just think that any industry that has those sort of margins had better watch out from behind, because lots of people will want to get those margins, and it is ripe for disruption. So, and internalisation is one form of that disruption, and there will be others.
And I think the other key point that Fiona made is we want those margins to go to members in future.
Indeed.
Other comments on that? No? Okay.
Well, I think if the margins are going to stay that high, there may well be disruption. If disruption comes, what is going to keep the fund with you as a fund manager? And it won't just be the returns, it'll be all the stuff that is built around that. So one of the things that's been spoken about a fair bit recently is strategic partnerships. So a fund manager not just providing a return series, but a fund manager providing insights, analysing opportunities in markets where they are the experts, etc. So for fund managers, I would say if you want to keep those sort of profit margins, or even if it comes down a bit, you've got to build value into what you provide to the funds at every step. Don't just provide returns, provide them with insights, etc., so that you become indispensable to the fund. Because otherwise, if you're just providing a return, you're going to get the flick at some point.